Hello everyone, and welcome to the first webinar of Technology Transfer webinar series. Before we kick off with today's presentation, I would like to give the floor to Luca Escoffier, Project Manager of EU Japan Technology Transfer Helpdesk. Luca?
Yeah, hi Eva. Good afternoon.
Hi.
Hello everyone. I don't know if you can hear me okay?
Yeah, loud and clear.
All right, excellent. So, welcome everybody to this first webinar of the EU Japan Technology Transfer Help Desk. I just wanted to say to everyone that this is a new service that has been launched, is going to be launched by the EU Japan Center for Industrial Cooperation. I'm now talking to you from Tokyo, so here it's a little bit late. But hopefully the topic is very interesting, and Efrat will be also as well very interesting. So we'll all be awake for at least an hour, hopefully. Here on this slide, you can see the email that you can use to reach me if you have any questions after the webinar or anyway in the future. And this is the website, also the line below, www.eu-jp-tt-helpdesk.eu. It will be active from February 10th, so you can try to use it now, but it will say that it doesn't work. So please wait until the 10th, and then hopefully you will be able to see the website. And once again, you can always reach me to ask me any question about the new service, which will basically be concerned with technology transfer practices, best practices. We will have presentations, videos, interviews, and of course technologies that will be available for licensing. And at the very end, we will also find a URL that you can directly click. And if you're an SME, if you work for an SME in Europe, please do me a favor, do us a favor, and fill out the form. It's a very, very short survey that can be very useful for us for the help desk. So I hope you will find 3 minutes to do it. And of course, if you know other colleagues in other SMEs, feel free to share. And that said, I think I'm done. I will leave again the floor to Eva. Thank you.
Thank you, Luca. I would like to start today's webinar with a short presentation of Ms. Eflet Kaznik, our guest speaker. She's an intellectual property valuation and strategy expert with over 20 years of consulting experience, focusing on assisting companies with management and monetization of their IP and technologies. She's the president of Foresight Valuation Group, a Silicon Valley-based IP valuation strategy and startup advisory firm. She is also a lecturer on IP management at the Stanford Graduate School of Business and a mentor on IP strategy issues at the GCB Center. Ms. Kaznik is the chair of the Internet of Things Committee of the high-tech sector and has also been listed on the top list of leading IP strategies 4 years in a row. Currently, she serves on the advisory boards of several startups, accelerators, and venture funds in the US, Europe, Asia, and Israel. So without the further ado, I would like to give the floor.
Good morning, everyone, or it's my morning. Good evening, everyone. I'm very excited. Can you hear me okay, Eva?
Yes, I can hear you loud and clear.
Okay, great. I'm very excited to be here this morning. I'm very happy that you all found the time to dial in, which I know is your afternoon. I appreciate that. I'm calling you from my office here at Stanford University at the heart of Silicon Valley. And I wanted to thank Luca, who's been a long time affiliate and partner of mine, for inviting me to speak. I understand this is kicking off the series of webinars that the EU Japan Center is going to host. Very excited to be the first speaker. The presentation, the slides will be projected along with my talk, so hopefully you can follow. If you have any questions, you can type them in the chat box, and I will try to address as many of them as I can. After my official presentation is over, we will have Q&A time for that, and anything that does not get addressed today, we will address them by email. So I'm going to make sure that all your questions get addressed. As you can see, my career took me into the area of intellectual property, where I've been consider myself very fortunate to have had the opportunity to not only be here in Silicon Valley and see a lot of technology come in, but actually be part of the intellectual asset management movement, which started in the late 90s, where my career started. I've had the opportunity to work with a lot of organizations, big companies, small startups, universities. I know we have a diversified crowd today on the phone, on the call. So I'm going to try to address the world of intellectual property spans different types of industries and organizations. So I'm going to try to make it as relevant and as applicable to as many of you as I can. But a lot of the principles and the things that I'm going to discuss today are going to be very universal. So things you can apply across the board and really have some understanding of IP valuation. That is one of the main driving forces of how intellectual property is transferred between companies and organizations. Our outline today includes, first of all, I would like to address some of the problems we have with IP valuation. We live in a world of open innovation, and technology transfer is the way that intellectual property is transferred from institutions, research institutions, to industry, between companies, from startups to big companies. There's a lot of ways that intellectual property is transferred, and the valuation is at the heart of that. So it's something that allows the transfer of IP, but at the same time, there are some issues with the valuation of intellectual property that I would like to highlight for you. Next, we're going to move to some of the circumstances, some of the more common circumstances, and some of the methodologies that we use, we, the practitioners that do IP valuation on a daily basis, like I do, to tackle that issue of intellectual property valuation. I'm going to bring examples from big companies. I'm going to talk about startups. And I'm also going to bring a case study from my practice that highlights the contextual value of intellectual property. So I hope you enjoyed the next 35 minutes of my talk, and later we'll have a Q&A, and we can stay here as long as needed to address all your questions. Starting off with some definitions. So when we talk about intellectual property, you also hear names like intangible assets, intellectual assets. There's all sorts of names for that. Today's talk is going to be focused primarily on patents. So if you look at the legal definition of intellectual property, and I also have to say that a lot of what my insights are coming from the US market where I work, but I work also with international companies. So to the extent that there are differences, I'm going to try and highlight them as I go along. So when we talk about types of intellectual property, from a legal perspective, there's 4 types. There's copyrights, trademarks, trade secrets, and patents. Today's talk is going to be focused on patents, but the reason I'm showing this picture, and this is a picture that I show in every class that I teach, it's really important to understand that, for example, if you look at the Tesla or any type of product these days, really there's all 4 types of IP are present. Copyrights usually are protecting software. Trademarks are your names and logos and your marketing type of intangibles. Trade secrets and patents usually go hand in hand, protecting technology. Today's talk, we're going to talk about patents. The interesting thing about patents is there's a lot of strategy and there's a lot of things you can do with patents that you cannot do with the other intangibles. So a lot of the valuation principles and practice is focused on patents. So the remaining of the talk today, we're going to focus on patents. So the first thing that I want to highlight is the problem, the gap, what I call the IP valuation gap. So in February 2014, I used to have a column with the IAM magazine. I'm sure a lot of you are familiar with that. It's a it's a leading IP publication based in the UK, and I used to have a column on IP valuation. And I wrote this piece to highlight the invisible nature of intangible assets. So why am I saying that intangible assets are invisible? There's an IP valuation gap, and part of the problem with IP valuation and why people are really struggling with what is the value of IP is a result of pretty much the accounting treatment of IP. So while this is not an accounting talk, it's really important to understand that the financial reporting systems is how companies report their assets. So the problem starts with the accounting reporting of IP, but it's really a business problem that is actually relevant for everyone. So you don't have to be a public company. Anyone working in the world of IP that wants to have a glance into what is the value of intellectual property will find it very challenging. So the first part of the problem is what I call a reporting gap. The reporting gap and these reporting financial reporting rules are universal. So in the U.S. it's U.S. GAAP. But what the other accounting rules around the world are treating intangible assets pretty much the same. And the problem is that your internally grown IP assets, so your patents, your trademarks, everything that you develop in-house, is not you're not required to report it on your financial statement. So you don't have to be an accountant to understand that there's a balance sheet and the companies report their assets on the balance sheet so that investors, the capital markets, anyone who wants to see the assets of that company can open a balance sheet at the financial statements and see that. Well, if they open the financial statements of companies that have patents, they are largely not going to see anything on it as it relates to patents. The only patents that you're going to see on the books of companies are patents that they acquired. So the way the accounting rules work is when you acquire a company in an M&A transaction, then you need to report the assets of that company, including the patents, on the financial statements. However, your own patents are not on your financial statement. So that's very important to understand. The second problem is a disclosure gap. The disclosure gap means that most IP transactions, as I'm sure a lot of you on the call know, are very confidential. So there's no reporting requirement, there's no transparency, there's no like real estate database that you can go to and find values of patents or royalties or things like that. So that's another problem. The third problem is what I call the comparability gap. So even if you had to report your patents and the transactions were visible, the assets are not very comparable. So it's very difficult to compare one deal to another, one patent to another. These are very unique assets, very innovative and different from one another. So even if you had full transparency into transactions, it would be very difficult to compare. So I know that's probably a lot to absorb. So I think the easiest way to explain that is through an example. And the example I'm going to go over is the Google Motorola acquisition, one of the largest deals to be driven by IP that ever took place. And it's a very complex transaction. So I'm not going to go into all the reasons and factors that drove Google to acquire Motorola, but it was largely agreed in the market that the very large patent portfolio, as you can see in this slide, where you can see the fact that Google, going into the mobile market at the time, had a very large market cap, but a relatively small patent portfolio. And they were competing with companies like Microsoft and Apple and companies that had very large IP portfolios. So what you see in IP, and there's always going to be a strategy element in here, is that a lot of companies like Google need to grow their IP portfolio very quickly, and that was a good target for them to absorb. So the price of the deal was $12.5 billion, and a lot of observers at the time were wondering, um, what is the price of the patents? What is the price that Google is putting on the patents? Is the entire price allocated to the patents? Now, if you know anything about accounting, you know that that's probably not true. But there's a company, there's an operating asset. The patents were not the only asset of the company, but the question is, why was there so much ambiguity about what is the value of this very large IP portfolio? So we talked about three types of gaps. So what I'm showing you here is I'm showing you the balance sheet of Motorola Mobility at the eve of the acquisition. So just before they were acquired by Google, this is a slide that I'm showing in my Stanford class, so it's taken directly from there. And it's a very interesting case study that we always cover. You can see that if you look at the there was no line item for patents. So the value of patents was zero. There was no value assigned to patents on the Motorola balance sheet. And that is because these are patents that they developed internally using their own R&D. So right there, I'm showing you the reporting gap. Now, we also talked about the disclosure and the comparability gap. So if you look at this chart, this is a chart that was issued using data from Intellectual Ventures, which is one of the largest patent aggregators in the US. You can see, and you can see you can find a lot of this data floating around in the market. This is data that shows patent prices over time. These are average prices per patent. Always have to take this data with a grain of salt. But what you can see here is you can see that right there, you can see that there's a lot of outliers. So there's some deals like the Commerce One deal or the Nortel deal that happened at the time that put a very high price per patent, approaching $1 million per patent. You can see that the average in the market was $100,000, give or take. But really, what this table is showing you, or chart is showing you, that there's not a lot of these deals that are being disclosed. So this is just there's a handful of them that you know about, and also that the prices are really all over the map when it comes to some of the larger deals, as opposed to the average. So it's very difficult to use an average price per patent as a comparison for anything. So right there, through this example, we saw some of the problematic aspect of IP valuation. The next thing I want to go into is understanding a little bit of the circumstances and the methodologies of how IP valuation is actually done in practice. When do you have to do it? And what are the ways that the methods that you use to value IP? I'm on slide number 12. So on this slide, you can see the various scenarios where companies value intellectual property. Now, it's important to understand that you see that I used two colors here, dark blue, depending on how your computer shows that, and a light blue. The circumstances in light blue are circumstances of compliance. So this is where you absolutely have to value your IP. And it usually happens in financial reporting situations of M&A, that, as we showed, this is really the only time that you actually value your IP, the IP that you buy from another company. The other one is transfer pricing, which is a tax related. So when you have tax planning, you transfer your IP from one country to another. A lot of European countries are actually on the receiving end, like countries like Ireland, on the receiving end of a lot of IP that is being transferred from regions like the US, where you have a higher tax rate. We're not going to talk about that today, but I just want to highlight this as one of the scenarios where you see IP valuation done. You have to value the IP. And litigation damages, again, is a special case that we're going to talk a little bit about. Everything else that you see are things that you do when you value IP, but you don't really have to. So you can do all sorts of licensing and transactions. You don't have to report the value of the IP. So a lot of companies, some people are doing a formal valuation. Some people are not doing it, depending on how experienced you are. If you're a licensing professional in a university, I know we have a lot of people on the line. Sometimes you have all sorts of rules of thumb or heuristic guidelines, but you don't really do an official valuation that you need to report somewhere, like you do in an M&A situation. So that's why I divided the circumstances into two types. So when we talk about IP valuation, we need to remember that it's very contextual. Okay, so what that means is that the path that you go through impacts the value. For example, if you are an operating company, and you can see the types of companies, by the way, I use the acronym NPE, which means non-practicing entity. It's a US jargon for what we call a patent troll, which is an entity that buys patents to enforce, to sue other companies. So if you are a university that is licensing patents or spinning off patents into a new company, the value of that IP is going to be very different from if you take the same patents and gave them to an NPE for enforcement. Very different value. The value really depends on who holds the IP and what they can do with it and what they choose to do with it. And the nice thing about IP is there's usually more than one thing that you can do. So it's usually a scenario exercise where you figure out what are the multiple scenarios, what is the value of the IP under each scenario. And this can sometimes be additive. Sometimes you can do two things at a time. Sometimes they're mutually exclusive. So we'll go through some examples and we can see that more clearly. So when we talk about the IP valuation process, it's really important to understand that there's some preliminary steps that you need to take in order for the valuation to be meaningful. Okay, you can add, you can run numbers and end up with something that is garbage. Okay, something that means nothing. And the reason, usually I see a lot of that done by people sometimes. And sometimes the reason for that is that they didn't do their homework. And the homework is you really have to take two steps back. First of all, you need to understand why are you doing the valuation. And there's a variety of reasons, like we saw. Is it done for financial reporting? Is it done for transaction? Is it done for, what is the reason for doing that? Then usually, if you have the budget and you have the time, you really need to analyze the assets. So let's say we're talking about a patent portfolio. So what you need to do in order to get to the third step is what we call the valuation scenario, is you have to analyze the assets that you are trying to value using the three disciplines that participate in intellectual property. One is a technology analysis. So looking at the patented inventions, what technology they cover, and understanding that. The other one is a legal analysis. That goes to the letter of the claims. So especially in the US, it's very important how the patents are written. Okay, some claims are written better than others, broad, narrow. You look at citations, you look at all sorts of things that imply the quality, the legal quality of the patents. The last thing is a business analysis, which is actually looking at the markets and looking at products in the market. So all these need to come into consideration when you do the assessment, or we call the evaluation, and then you come up with some valuation scenarios that you are trying to quantify with numbers. So the IP valuation that I talk about actually ends with a number that can be in dollars or can be in euro, but it's a number, it's a monetary number. So we're talking about actually putting a number on intellectual property assets. But you really have to go through all these steps for when you get here, the valuation, when you get to the valuation scenario, it becomes more meaningful, and the numbers make sense. The next thing that I want to point out are some of the IP valuation methodologies that are commonly used. As you can imagine, this can be the topic of more than an hour of discussion in and by itself. but I would like to, at a glance, I would like to touch on these so that you have a context to some of the examples that we're going to talk about. So if you are familiar with any valuation in the tangible world, the business valuation, there's usually three types of methods that we use to value any asset, not just intangible asset. One is the market approach, and the market approach is based on market comparables, okay? Market-driven comparables. This approach, as we already discussed, okay, we looked at some patent prices, is really most desirable if you think about real estate. Okay, that's the perfect asset that lends itself to a market approach. You can look at the two houses. They have the same number of rooms, the same number of bathrooms, the same location, the same zip code. You can make a comparison. Not so much so with patents. And as we all already mentioned, the data is usually not there. Okay, there's a gap. There is a reporting gap. So this approach we usually kind of do in the background as a benchmark, but it's hard to use this as a main approach just because there's not enough data. The cost method, so I'm going down here, is one that also is can be used, which is quantifying the cost of creating a functional equivalent of the asset. That's the definition of that. The problem with this approach is that it doesn't really mean much. So if you think about patents, and in the case of patents, if you use the cost method, that would be the cost to design around. So what a patent is doing for you is giving you an exclusionary right, the right to exclude others. So if you wanted to replicate a patent using a cost, what is the cost to create a patent, is really what is the cost to come up with the feature in the patent that excludes other. So that's, the textbook definition of the cost approach. But really, if you think about a patent, you can invest a lot of money, but at the end of the day, if nobody wants it, then the cost method is not a good measure. It has no measure of demand. So it would give you a very partial picture of what the value of the asset should be. So really, what we use in, I would say, 95% of the cases with patents is an income approach. And an income approach is an approach based on the net present value of a stream of royalties that you either save by owning the asset or that you can generate from others. So it's a royalty-based approach that I'm sure a lot of you are familiar with. It's a universal concept. I want to show just briefly the elements of the royalty approach. There's a lot of information that you need to gather. Not all of this information is available. The royalty rate, for once, is again a highly confidential piece of information. Companies don't usually report their license agreements on their on their financial statements. So you need to there's databases in the market which are all based on publicly available data. So they're not very good usually. So it's usually a combination of what you can find and what you know, and you need to speak to people in the industry who are doing a lot of licensing, and so the picture would emerge of the royalty rate. The other data that you need is the royalty base, which is the combination of the products and the technology. And you also need information like a discount rate. And what you do is a net present value calculation. I'm not going to go into that in great detail, but the idea here is whatever the stream of royalties that you can either generate or you can save from owning the asset, you bring it to net present value using a discount rate, and that gives you some indication about the value of the patent. Again, this is oversimplifying it, so there's a lot of nuances to that, but I just want to, in general, describe the methodology. Okay, so far we've gone into the valuation gap. We talked about some circumstances and methods. Now I want to highlight a few what I call special circumstances. I want to talk about startups as an example, and how IP valuation plays a role in there. So I started out by saying that I'm calling you today from my office at Stanford University. I'm based in Silicon Valley, and I work with a lot of startups. I've also been an entrepreneur myself, so this is a piece of my bio that I'm very proud of. So really, in the case of startups, a lot of startups are trying to use IP and patents for funding. And the thing to understand when you're doing that is that it really depends on what type of funding are you. So when we talk about the types of funding, when we talk about debt versus equity, and then we talk about institutional investors, which is venture capital, as opposed to strategic investors, is where a company invests in a startup. Okay, so that's what this table is. So really, depending on the type of investment that you get as a startup, you can leverage your intellectual property in different ways, and the value that whoever is giving you the funding is placing on your IP is what I'm showing here. Okay, so I can give an example from a client that we had. They had some IP, they had patents, and they had software, and they wanted to raise $25 million, which they actually managed to do. Some of the funders were lenders, okay, like Silicon Valley Bank is an example here in Silicon Valley. They would lend you money against your patents. There aren't that many banks that are doing that, but there are some. So what these type of investors are concerned about is what we call the liquidation value. And that goes to the context. So we talked a lot about the context of the valuation. So for a debt lender, for them to lend you money, they want to know that they can easily liquidate the assets. So should you default on your loan, they can take it and they can sell it. That's all they care about. When you talk about an equity investor, there's a little bit more of a long-term view. So when they look at the IP that's being offered with the company, when they try to put a value on it, the value is more of a what we call a pivot value. I'm going to explain that in a minute. So the IP needs to be such that if your current product doesn't succeed, is not successful in the market, you can pivot into other products using the same IP. That's really, really important. Now, just mind you, I just want to put it out there that most investors don't really understand that. So there's a lot of education that needs to take place. And I'm going to explain that in a minute too. When we talk about a strategic investor, we see these less. We mostly see the situation of the institutional investor. But when we talk about a strategic investor, if you're a company and you are investing through a venture arm, investing in a startup, if this is either debt or equity lending, the value of the company can get from IP is different from the value that an institutional investor can get from an IP. So if you, let's say that you are Microsoft and you're investing in a startup that has IP, if you are structuring it as a debt investment, so that means that if they default, you take over the assets. There's some monetization value for you, that you can take these patents and you can actually start licensing them, or you can also, there's synergistic value, which is you can include them with your own products that institutional investors cannot do. So as a strategic investor, there's even more value to what you can do with the IP of company that you invest in. So when you try to explain the value, if you're a startup or if you are the company looking at a startup, these are the kind of things that you need to keep in mind when you look at the intellectual property. So it's not just counting patents, which a lot of investors are doing, just counting patents. It's also understanding what kind of value these patents hold for you as an investor. Want to give actually I want to highlight a little bit more about actually we touched over most of these. The valuation is becoming a key issue to a lot of these. So when we talk about pivot value, for example, that's a really important concept, but I can tell you that even in Silicon Valley, most VCs don't really see that. So a lot of people are looking at intellectual property and they're seeing the defensive value. So you say, oh, you have a patent on your product, check mark. Where really what they should be looking at is this kind of IP, what platform for innovation and growth does it provide to the company? So if the current product iteration fails in the market, which happens to over 90% of the startups, right? Do you have enough in there? Do you have enough pipeline? What is the structure of your IP portfolio so that you can support future growth? Or that if we, the investors, are left hanging at the end and you go under, is there something that we can sell at the end of the day that's valuable to another company? So this is in the circumstances of a startup are a little different from a big company in that the IP is very foundational for growth and funding. Um, and just I at the end here I said that it needs education because a lot of investors don't understand it. But I just wanted to bring it up with you guys. Actually going to conclude here. We're almost we're getting into the 35-minute mark, so I'm gonna spend a few more minutes here on an example to make sure we have enough time for questions. And this is a case study that I always bring it up in my presentations because it really shows the contextual value and the different scenarios of value that intellectual property can have to different companies. And the case is actually I'm going to jump one slide up and then I'm going to describe that and then we're going to go back. So I actually want to pause here and say something about the US market as opposed to the European market. So in the US market, as I'm sure a lot of you know, the enforcement model, so the model that involves litigation and what we call stick licensing, and we have a lot of entities that their business is the enforcement business. So there's a lot of litigation going on, and there's a lot of strategies around that. From what I know about Europe, I know that there's a change coming to the patent regime, the unitary patent, and some changes to the patent court system in the EU. So some of that stuff might become relevant in Europe as well, where if from what I'm reading, I'm hearing that there could be the enforcement regime in Europe is going to become more effective and stronger. So some of that type of strategies might show up in Europe as well. But in the US, you see a lot of my work. There's always a litigation and an enforcement aspect to every IP strategy that I see in the US. It's just the nature of things. So in this example, we have two companies. We have three companies. Company A, who's a large LED light manufacturer, an IP holder. There's Company B that came from China with cheap LED light bulbs that Company A thinks are infringing on their patents. So what Company A did is they filed a patent lawsuit against Company B and with an injunction to try and stop them from making those products that are infringing on their patents. Now, Company B, usually the strategy is countersue. So a lot of times you see in court is the one company sues another, the other one sues it back. However, you need to have patents in order to countersue. Company B didn't have anything, but Company C, who was my client, had a very interesting patent that Company B could take and use to countersue Company A on an entirely different product. Okay, you see that a lot. So this is a play on what we call the freedom to operate. So you find something that you can it would be a problem for the company that's suing you. In their freedom to operate, it could be in an entirely different line of business, and you can take that patent. Now, Company C was not using this patent at all. It was sitting on a shelf collecting dust. So for them, there was kind of, found money, right? I mean, there was no value for that patent for them whatsoever. It was non-core to their business. So here are the facts again. We have Company A, who is a large LED leader, Company B, who is a Chinese manufacturer entering the US market, and no patents. And then we have Company C, who is a mid-sized LED component maker with very valuable IP assets. So the question here was, Company B approached C to buy the patent, and the question that our client was asking us is, what should we ask for this patent? Now, as you can see, this is not an easy question to answer. So this is a pure valuation question, but there's strategy elements to it. So we need to lay out the scenarios. So what are the scenarios? What are some of the alternatives of things that you can do with this patent? Or how should Company C look at the value of this patent? So here are some of the options. This is usually a very interactive exercise, and I would have loved to see your faces and hear your answers, but due to the medium of the webinar, we are going to jump into the answers. And then that's the last thing I'm going to cover, and then I'm going to open it to questions. So, and if you have any questions about this example, please feel free to ask them during the Q&A time. So really the value the company see with the seller, you can look at the cost method and say, oh, it's what is the cost to develop this patent, which I'm sure you can agree with me would be missing a lot on the value in the market of this patent right now, because it's highly valuable for company B. Another thing is there's an opportunity cost there, which company A is a client. So do you sell a patent to somebody who's going to sue them? So that's another question. That's another cost you can quantify. But the value to company B, the buyer, is what we call the litigation avoidance. So for them, they're willing to pay a lot of money for it because it increases their chances of making the litigation go away. So it is the delta of probability with and without the patent applied to the litigation, what we call damages. So again, that's a different type of calculation that we can do from a valuation perspective that figures out what is the value to the buyer. Okay, so the value to the seller, as you can see here, is much lower at this point than the value to the buyer. But the really interesting question is, what can you, company what can you, company C, do with a patent that can get you even more value? Well, you can also actually sell it directly to company A. They might be able to pay even more than for this patent if they know that it's going to fall in the hands of company B, for example. So that's another option. You can sell to another competitor. You can do an auction. I mean, there's a lot of things you can try and enforce yourself. You can go after a bunch of players because obviously this patent is very valuable. So these are all the things that you need to consider when you come up with a scenario analysis, and then we can put values on each of these using the methodologies that I showed you and come up with some recommendations. So what are some of the key takeaways from my talk today? So if you come out of this today remembering one thing, hopefully it would be that there is an IP valuation gap. So there's a IP valuation is really important for technology transfer, as you see. But the problem is that we really don't have a lot of information on the value of IP. So, we work with what we have, but it's important to be aware of that. The other takeaway is that there are there's different types of valuation methods, and the valuation is very contextual. It depends on the type of IP, depends on the holder, depends on what they plan to do with that. The other thing that would be a key takeaway from today is that particularly in complex IP transactions, the contextuality of the valuation, like the example that I showed you, becomes even more pronounced. Okay, so it's even more important to understand the scenarios and the circumstances. And also, I want you to take away one bright spot, is that the use of IP valuation is increasing in startup funding. There's still a long way to go. There's an education with investors, but we're seeing that a lot of our clients are beginning to leverage their IP for funding, which I think is great. So with that, that concludes my talk today. I'm going to open it for questions. And at the end of this, there's my contact information in case you want to email me after the call with any other questions that you have. So I'm going to turn it over to Luca and Eva to conduct the Q&A.
For the presentation, as usual. Great, lots of information and great presentation skills. So yeah, I'm here, more than happy to receive the questions if there are questions from the audience.
There's one question from Rai Kumar. Will it be possible to get a PDF copy of?
Yes, very technical question. Yes. Yeah, we will display the presentation on the website of the Helpdesk in around a week when it will be launched. So yes, the answer is definitely yes, as well as a video of the webinar will be available, so you can re-watch it and re-listen to it whenever you want.
Okay, great. Thank you.
I see a lot of
We have
congrats,
another,
which is
yeah,
good.
couple questions coming up
Thank you.
that I can see. So we're just gonna give a couple of minutes.
And once again, Efrat, if I may, you already said that, but of course you're available if anyone has additional questions. Maybe not today directly, but
Okay,
you
great. I
you
see
and me are
a few questions coming in. Let's see.
market date, good database, or licensing deals, or finding
Okay,
licensing.
something about the differences. Okay, so do you want to read these to me, Luca? I see that a few things are coming
Yeah,
in.
can you hear me
Okay,
okay?
I can hear you.
Yeah. Yeah, okay, excellent. So one of the questions says if there are any databases that might be good to look at for finding licensing deals and things like that.
Yeah, I would say that for royalty rates, there's nothing that is great. They're all about equally as bad. The problem is that they're all based on public information, and as we said, public information is not often disclosed. There's the things like Royalty Source or KT Mine in the U.S. Most of them are by subscription or you pay by the search. That is in terms of royalty rate. In terms of transactions, there's a few organizations that follow the ones that are disclosed. If you send me an email after we hang up, I can send you some links to that, and I can make it send it through Luca to make it available to the other participants as well.
Okay. Then there is another question regarding the possibility to resort to these kind of services, valuation services, and they're asking if there are companies doing that. And well, if you want, I can answer to that because Efrat is herself a professional doing this kind of job and valuation. So you have direct access to her, and you can contact
Hmm.
her from
Yeah.
the slide.
I see a question here about could company B
Yeah.
attack the patent of company A in invalidity? Yeah, I can say a word about attacking for invalidity. There's a process now that was instituted by the AIA, which is the American Invent Act, which is the patent reform in the US that happened in 2012, where it's very easy to invalidate patents. You can take them back to the patent office itself. Um, and you don't have to be a site to a litigation. You can do a third party can do it for you. So what the impact of that is that it somehow weakened a little bit, not a little bit, but it weakened the enforcement business model in the US. So you see companies doing less of like the pure enforcement, like a patent troll, and more like a little more sophisticated business models that try to go around that. So I mean, you can attack for invalidity. Um, that's a strategy that company B could have done other than countersue. So I agree with you that's a valid option for them. Um, it really depends on how much patents are being asserted against you. So oftentimes companies, because it's easy to do that, don't just go with one patent. You sue you on like 5, 6, 7, 8, 10 patents. And then if it becomes, if you're not very savvy in the process or it's expensive, it becomes, it's very difficult to invalidate all of them. So it really depends on the structure, the nature of the lawsuit.
All right. Thank you. I see another question about the availability of the presentation. Yes, as we mentioned, yes, it will be available and downloadable directly from the website of the Helpdesk from next week.
I think I see another question here that says, apart from the IP valuation, Which is your approach to other intangibles, if I understand the question correctly? Um, if I understand the question correctly, is would other intangibles have different valuation methods than patents, if that's the question? And the answer is the valuation methods that I showed, the three types of methods, these are applicable across the board. So regardless of your intangible, these are the valuation methods. Some intangible assets like software, in some cases, you see the use of the cost method more than other assets. In some of them, if there are good comparable, like in trademarks, sometimes there's better comparables than in patents to use a market method, but usually most of the valuations are you use some sort of an income method, so it's based on royalties. That's the universal language that everybody understands. So and this is the kind of calculations that we're used to seeing in most valuations of intangibles.
I can see an interesting question about the pricing. So one of the attendees is wondering, what is the price range for this kind of services?
Oh, let me take that offline. Email me with your questions and I can provide a quote. Happy to do that. It depends on the purpose, really, and the size of the portfolio and how quickly you need it. Happy to address that. You can send me an email. You can figure it out.
There are some
Okay.
additional questions, I guess.
I see something about universities sharing data. Any obstacles? Yeah, so I would say that actually universities, of all the groups of entities, share a lot of data between them. There is an organization in the US called AUTM, the Association of University Technology Managers, AUTM. They have a lot of conferences. I'm here, Luca is a member, I know. A lot of conferences, and they issue studies and they share a lot of data. So I would say that there's actually, as far as I know, strong sharing of data. The other place to look for that is LES, which is an organization that I'm a member of and very active in, the Licensing Executive Society. This one has not just universities, but also companies. There's a lot of education and surveys and studies that they do, so you can get some data through that organization as well.
Okay. There was a question.
Expertise in
Wondering about your.
There's something about nanotechnology IP, so I just want to put it out there that Luca, I've been asked to contribute a chapter on IP valuation in a book that Luca is actually an editor and that's his book. So nanotechnology IP is one of the areas that both me and Luca are one of our areas of expertise. Luca, do you want to say a word about nanotechnology IP?
Yeah, it's a book that we co-authored together with almost other 20 authors, 2013. Yeah, so Efrat contributed with a chapter on investing and valuation of nanotechnology, and so it's pretty much covered in the chapter. So I would say that yes, she has expertise, definitely. So I'm sure that she's open to additional questions.
Yeah, I used to be the chair of the nanotechnology committee for a licensing executive society, LES USA Canada. So and both Luca and I actually, Luca helped me organize. We organized a lot of panels and events, and that's an interesting kind of IP. Like a lot of university IP, it's basic research. A lot of it is not commercialized yet. So the challenges of valuation in a circumstances like that are a little different than when you look at mobile patents that are infringing products in the market. So it's a very different type of valuation and analysis that goes into that. But I strongly recommend Luca's book as a starting point for understanding not just the valuation, but all the other aspects of managing IP in this type of industry.
Yeah, there is someone mentioning yet that our association that we have in Europe, ASTP product exactly, which is like Autumn and Unit in Japan. Yeah, I don't know if you can see
I can
the
see
question about
some.
the LES. Okay.
Okay, so as a German member, well, there's LESI, which is LES International. You should, if you're a member of LES, even international, not the US, you should have access to the US reports. If you want to send me an email, I'll make sure that they do a royalty survey every year. If you want me to send you that, I'm happy to do that. Just send me an email and I'll send it to you.
I can provide my details. Yes. Eva, I don't know if the next slide is again the slide of the help desk or.
Yeah, why don't we switch to that so we like.
Yeah, these are my contact details. So you have my email, and the last line once again is the URL of the help desk that will be active from February 10th, and you will find the presentation and also the video of the webinar.
Okay. This is something here about equity spinouts from Jari. So I'm not sure what the question here is. You just say that mostly in your case, equity is taking for spinouts. I'm assuming you're calling from a university. It's usually one of the most common mechanisms for tech transfer, at least here in the US, is for spinouts of IP. So there too, you have to do a valuation. I don't know if the question is about valuation, but the valuation is actually really important because there needs to be some equity rights allocated. So the university contributes the IP, somebody else contributes the complementary assets, what we call like cash, manufacturing, people. So there needs to be the value of the IP becomes the basis for the equity share of the university, or actually big companies are doing that too, not just universities. So it's an interesting case for IP valuation.
All right. I think we are pretty much set. Eva, if I'm not wrong, right? Because it's.
Yes. I don't see any other questions coming up in the chat box.
Okay, excellent.
So I guess that would conclude today's session.
Yeah, thank you, Eva, for your help, and thanks, Efrat, and thanks everybody, of course, for joining the first webinar, and it was really exciting, and I really hope to see you online, of course, next time.